Hi, everyone. Let me start this webinar and welcome everyone to it. I think, we had a ETF webinar last week when things were looking very bright and very exciting, and much has changed since, but we will fight very hard to reverse what has happened. So let me tell you why we think that it's critically important that investors and savers are offered a choice of international investments in particular, and the choice of accessing a broad range of international investments. And really it all has to do with what has happened to South Africa, both pre-COVID-19 and then subsequently to COVID-19. So if you look at South Africa, and many of these themes apply globally, but this crisis has hit, the very fundamentals of our economy, which is the consumer. So you need to understand that basically the entire economy and the wealth of the economy is dependent on people spending money on goods and services. And where we are looking at unemployment, additional unemployment in South Africa of between 1 to 2 million people as a result of the pandemic, never mind unemployment globally, you can see what impact it will have on the returns, well, on basically the profitability of companies and businesses in South Africa, those that have still survived, and their viability as an investment opportunity to you as an investor. We've seen many strange things happening in the market. We've obviously seen massive price dislocations, oil price, gold price, Bitcoin price all over the place, as people just don't know what to do with their money. In response to the crisis, we have seen unprecedented levels of money printing, particularly in the US and Europe, as well as the emergence of negative interest rates. So this is where literally bonds are issued at negative interest rates. So 100-year bonds, Austria issued a 100-year bond at a negative, I think it was 0.2% yield. So you are paying governments, the safe governments or perceived safe governments, to hold on to your cash. And that is probably, that environment of negative interest rates internationally is probably the saving grace of South Africa, and the only saving grace of South Africa. Because as you have seen, we have seen, sovereign credit rating cuts, and more will come. We are now 2 levels below junk, and in some cases 3. The ability to crawl our way back out of junk status, on average, it takes countries 15 years to do so. So the rand will remain volatile, and the only reason the rand is as strong as it is right now has been the search for yield. So this money printing offshore, inability to invest in anything that yields interest, and foreign investors throwing money at a bond market again, which strengthens the rand, which is why what has happened in terms of this legislation, which subsequently was withdrawn, is so unfortunate, because there was this opportunity for South African savers to take money offshore at a time where the rand is, has at least recovered somewhat post the March 2020 decline. I think we must all prepare for higher taxes and wealth redistribution. Again, that is happening globally, which is why you're also seeing a greater attraction of tax havens such as Mauritius, and why you are seeing record numbers of tax immigrants and financial immigration out of South Africa, of people who have money or who are looking for a better future. And obviously that's a loss to the fiscus. And again, the legislation that was put in place would have protected against some of that. I think, in terms of Regulation 28, there is a potential for some amendments. I don't think that prescribed assets are necessarily on the table right now, but, I wouldn't discount that as a tool in future. So prescribed assets are not on the table simply because asset managers have started to, it appears, so opinions are my own and gathered from facts that I draw from various different sources, but it appears that ASISA, the regulatory body which proclaims to represent the financial services industry, I view them as a lobbying body for large asset managers, has seemed to have made undertakings to government to invest in infrastructure. How they come to make those undertakings without broader consultation, I don't know, but in today's Business Day, Leon Kempfer, I think in a bit of a PR campaign in trying to recover the image of ASISA, seems to imply that those undertakings and discussions have happened. Again, I, as a member of ASISA, found it amazing and astounding that those kind of conversations are happening without, for instance, the involvement of all the members of ASISA, but be it as it may. We know they're not our friends. I think our corporates are suffering, and they will continue to do so, and the economy is in a bad state. And hence, from an investment perspective, take it down to basics. What are you in for? You want your savings to grow. To grow them in the South African environment would be extremely, extremely difficult. And we do require a new paradigm. And just for a brief period of 3 weeks, it seemed we had it, until lobbying behind the scenes resulted in suspension of this legislation. So basically, the South African Reserve Bank put out, and this announcement was made in the medium-term budget policy statement, so this was not random, as they are trying to pretend now. And basically what it said is a circular was issued by the Reserve Bank, published on their website, that all remaining foreign classified debt derivative instruments, as well as exchange traded funds referencing foreign assets, I'll talk to that in a second, that trade in rands will be reclassified as domestic assets. And that reclassification was to affect institutional investors, companies, trusts, partnerships, immigrants, and non-residents. So effectively, all those entities all of a sudden could invest in ETFs referencing or tracking foreign indices without restriction of regulation of previous SARB circular. Sorry, not Regulation 28. Regulation 28 doesn't prescribe foreign limits, SARB does. So SARB basically classified investments in these ETFs as being domestic in nature and hence not falling under their 30% restriction on institutional investors or retirement funds, retirement annuities, preservation funds. And that seemed like a huge step forward for South African investors. However, so this is effectively what happened. ETFs were reclassified as domestic investments. They moved out of the 30% limit to the 70% bucket. And, there's a provision in Regulation 28 that requires the look-through, and this is what some of the large active asset managers seem to place great reliance on, which requires that when you have an instrument such as an exchange traded fund, which is essentially a listed unit trust, that you still need to look to underlying assets to determine the issuer ratings, credit ratings, limits in terms of Regulation 28, and asset managers interpreted it themselves in the correspondence to the Reserve Bank, National Treasury, and FSCA as meaning that since you have to look through to classify the various instruments in the various categories, that you also have to classify them or reclassify them back to being foreign instruments. That is actually not what Regulation 28 says. And in fact, based on legal opinion that we've gotten and interpretation by lawyers, the Regulation 28 actually prohibits using the look-through principle to reclassify something that SARB has classified as being domestic back to foreign, and vice versa. So the look-through principle that large asset managers in lobbying for this legislation to be withdrawn used was deeply flawed and not premised on any legal principle, just on self-interest. And again, I'll chat to it just now. So let's look at exchange-traded funds and what is an exchange-traded fund versus a unit trust. Well, actually, in a weird and wonderful way, they are one and the same. An exchange-traded fund is a unit trust. It's subject to all the Sygnia regulation, which are the acts governing how unit trusts can be managed. But it's a unit trust that is also listed on the Johannesburg Stock Exchange. So something like Sygnia Itrix S&P 500 index tracking fund. And the advantage of exchange-traded funds over traditional unit trusts is that they trade continuously on the JSE, so you can buy and sell during the day. Whereas, as you know, when you invest in unit trusts, it's kind of a 2-day process. Your money is invested at whatever the market is priced at 3 o'clock in the afternoon. So you don't choose the timing of your investment, and a lot can happen between, 9 o'clock in the morning and 5 o'clock in the afternoon. So ETFs can be sold and bought continuously. They can be bought through platforms, list platforms such as Sygnia Itrix and Easy Equities, or through your own stockbroker. So if you're already trading in shares, you can buy ETFs in the same manner. There is never lack of liquidity in these instruments, like there is, for instance, in small cap shares, because every ETF has to appoint a provider of liquidity called a money maker. We employ one of the world's largest money makers, so it's a ginormous company, and they guarantee liquidity both for buyers and sellers at all times. So it doesn't matter if there is someone else wanting to sell an ETF or not. If there isn't someone else willing to sell you the shares, the market maker steps in instantly. I mean, it's an instant transaction, and you can buy the ETF or sell the ETF. So no worries about being stuck in an instrument you don't want to hold. Some of the disadvantages is that there are stockbroking charges that apply, and that sometimes, the prices of ETFs, because they listed, are subject to supply and demand. So they kind of tend to move, whereas the unit trusts are priced at the precise market value of the underlying investments at all times. But having said that, it's the job of the market maker to ensure that the deviation in price of an ETF from the actual market value of underlying assets is absolutely minimal. And they move in immediately to close any gaps. So examples of exchange-traded funds referencing foreign assets, in Sygnia's world, we have an MSCI World Index Tracking Fund, Europe, Japan, US, FTSE 100, S&P 500, and some interesting specialist funds such as the Global Property Fund, Fourth Industrial Revolution, Global Equity Fund. And Iva, who follows me, will take you through some of the more interesting funds that we are still launching to our stable of ETFs. So where are we now? Well, 4 weeks or 3 weeks into the circular, ex-con circular being in place, suddenly out of the blue last Tuesday morning, it was suspended pending public commentary, which is due by the 15th of December. It was suspended, and, I wasn't born yesterday. I have seen all the correspondence. So whatever you read in the press, it's just now spin by the parties involved. It was suspended in direct response to a letter written by ASISA on behalf of the industry without consulting the industry. So they consulted large asset managers. I know that Coronation 91 were involved. They wrote a letter, which I'm in possession of, and you can go on Twitter to read the letter. And they wrote a letter to FSCA, National Treasury, and the Reserve Bank demanding effectively issuance of guidance with regard to the circular by Monday. And really it was a demand, not a request. Again, read the letter. In response to the fact that they believed it conflicts with the look-through principle of Regulation 28 and hence is invalid. And this is more offensive to, I think, everyone on this call and, to everyone else working in the financial services industry. And that is the argument they use, that only active asset managers have the skills to make decisions on how much to allocate offshore, and that it should not be left to individual investors to decide how much of their money they want to have offshore. I know it seems absolutely unbelievable. Read the letter. I'm not making the stuff up. And as I said, ASISA did not consult its members. They didn't inform anyone of of this letter. Only a handful of large asset managers knew about it, because obviously there would have been a lot of objections to ASISA misrepresenting itself as the industry. And I don't believe that those asset managers who collaborated in this were driven by interests of their clients. They were basically looking after their own back pockets, because this legislation directly threatened their multi-billion rand bonus pools. Coronation's bonus pool last year, just published in November results, 1.1 billion rand that they stripped out in management fees and paid to themselves in bonuses. So as you can imagine, lots of money on the table. People kill for much less than 1.1 billion rand. So this is a very valiant attempt at killing this legislation. You could say, well, why would financial services, FSCA, National Treasury Sub, listen to ASISA? And I think you'll find the answer in today's Business Day. Leon Kempfer, as head of ASISA, talking about the fact that the industry, again, this collaborative body is involved with government in mobilizing assets for infrastructure investments in South Africa using retirement fund money. So I think that that's the power that they pretend to have, that they can direct money, retirement fund money, towards infrastructure investments, as opposed to you as an investor or boards of trustees of retirement funds as investors. And unfortunately, the regulators seem to have drunk the Kool-Aid. So we need to make sure that they hear the real truth. And it's not that each and every one of us should not strive towards potentially agreeing to dedicate a percentage of our retirement fund to rebuilding South Africa. I think particularly for those of us who want to live in the country and want some hope of a recovery for South Africa, we need to acknowledge that this is essential, because otherwise we are heading for a failed state. And truly we are heading for a failed state. I cannot tell you how depressed I was when I read Sygnia's integrated report, because our financial results are coming out in the next 2 weeks. And the chairman of Sygnia, Professor Harun Barat, is on the Presidential Economic Advisory panel. And he wrote an introduction to our integrated report. And if nothing else, you don't need to read Sygnia's integrated report, but when it appears on our website, please read that introduction, because I think it has nothing to do with Sygnia, by the way. It has everything to do with the economy and how the top economists in South Africa are viewing the path forward. And it was so depressing. I literally had to have a glass of wine after I read it. So now, what now? Basically, public commentary has been invited, and we are drafting a very comprehensive commentary regarding the circular, and we will solicit other industry bodies to co-sign that commentary with us so that it carries more weight. But I think what's most important to everyone listening to this call is that we need to create noise. We cannot allow the circular to just be swept under the carpet, because I think that the hope is that the circular just disappears and never appears again. So the more noise we make, the better, be it social media, be it whatever, whatever mechanisms are open to you. We need to talk about it. We need to make noise. We need to make public submissions, because we cannot allow few large asset managers who dominate this industry to hold every investor in South Africa hostage. They've done utmost damage to all of us through their actions. And really, this cannot be allowed to continue. And, we will fight it, whichever way we can. And this is why we have to fight it. If you actually look at the last 10 years, these are returns to the end of October. The all-share index over the last 10 years in rands has returned 8.7% per annum, whereas the MSCI World Index has returned 10% more at 18.2% per annum. And you might say, well, that's kind of okay. What does that really mean? When you actually compound it, you'll find that the all-share index delivered 130% over 10 years. So your money would have grown by 130%, but if it was invested in the MSCI World Index, it would have grown by 433%. So you would be 3 times richer than you are now. And then when you look at the currency, over the past 10 years, the all-share index in dollar terms has delivered 0 return to you as an investor. Absolutely nothing. Versus 8.6% per annum from MSCI World Index. So this is what we are fighting for. We are fighting for the freedom to manage our assets and to grow our assets. We're not fighting for some, undefined objective. We are fighting for the right to save and grow our savings in such a way that we can retire in comfort. So let's go back to Sygnia Itrix ETFs, because irrespective, I think that our investment vehicles offer very attractive opportunities. Obviously, we do have vested interests in this, but as passive managers, we've always had vested interests in ensuring that money moves away from highly priced, actively managed, underperforming products to passive products. So there's nothing new about it. Sygnia has the longest performance track record in managing passive investments in South Africa, with 17 years behind our belt. We were also the first asset managers to launch fully replicated equity indices, the first bond index tracking fund, listed property fund, risk profile balanced funds, those are skeleton funds, which are unit trusts, a balanced international passive funds, and then the very popular technology-focused passive funds, Fourth Industrial Revolution and the FANG Plus Fund. And we are the largest provider of index tracking ETFs on the JSE, excluding commodity funds, and the largest provider of international index tracking ETFs. Now, why do we believe in passive investing? Simply because it makes sense. You are paying very low management fees. So for instance, the S&P 500 index tracker charges 0.15% per annum, competes directly with someone like Coronation's Global Equity Fund, which charges 1.2% per annum. So you are paying 10 times less. A top performance, very wide range of themes and options available to you, very quick implementation, and top investors worldwide are opting for passive strategies. And when you've been in investments for 25 years, you don't stand in the way of the herd, because the herd will take you out. But the most important thing about passive management is that worldwide, it has won the performance debate. So despite millions of rands spent in advertising by active asset managers trying to make you believe that they outperform, they don't. A billboard is cheap. A billboard is not proof. So for proof, we look not at our own numbers, but at S&P survey, and these numbers are available on their website and in various reports they publish, but there is a website called SPIVA. And what they do is S&P looks at the general equity unit trusts listed in different countries, actively managed, and they look at the percentage of unit trusts that have underperformed a particular index. So in the United States, the number or percentage of general equity unit trusts which have underperformed the S&P 500 index. And over 5 years, which is what the bar charts show, the other numbers are 3 years and 1 year, 77.9% of unit trusts in the US have underperformed the S&P 100. In South Africa, 94% of actively managed unit trusts have underperformed the top 50 index. Australia, 80%, Canada, 97%, Europe, 72%. So really, if these are your odds of choosing, you are effectively assuming that you will be able to choose one of those managers falling into that small 20% building block. So your odds of choosing an outperforming manager in this instance are 20%. And you are 80% more likely to choose a loser. So why bother? And then if you just look at, and I focused on global equity unit trust, but the same thing applies to domestic performance, 1 year, 3 years, 5 years. If you just look at, never mind technology funds, which, you obviously have access to. There are 71 unit trusts in the general global equity category. Technology funds with, Feng Fund has delivered a 68% return over 1 year. Sygnia Fourth Industrial Revolution, 38. But more importantly, the generic S&P 500 ETF, 21 out of 71 funds. Way ahead of 91, Ellen Gray, Coronation, Prudential, and then MSCI World, 39 out of 71 funds. Over 3 years, which is probably more relevant, again, the technology funds right at the top, 3rd and 7th in its category. MSCI World Index is right up there, outperforming Coronation, 91s, Prudential, Ellen Gray. And similarly, over 5 years, S&P 500 right at the top of the surveys, again outperforming your 91s, your Coronations, your Ellen Grays. So why did they lobby so hard against these kind of instruments being classified as domestic assets? Because I think very quickly you would have discovered, not only through the process of moving some of your domestic assets into these international ETFs now classified as domestic, you also would have relooked at the most profitable part of the business of every active asset manager, and that is the international products, because those are the products they price at a premium. So there was huge risk, not only to the domestic assets, but to the most profitable business line, which is the international unit trusts, which they offer you, which have underperformed the index very, very significantly. And then, if you just look at the headlines in the Financial Times over the last 6 months, frankly, there isn't a single headline which talks to passive managers losing money to active managers, not one. Every single headline, there are many, many more, talk about world's biggest pension funds steps up passive stewardship efforts. Index tracking funds break through 10 trillion in asset mark. Majority of bond funds lag the market over the long run. Priciest active investment funds perform worst, study funds. BlackRock passive manager attracts $104 billion in new client money in second quarter. US active funds suffer record 143 billion exodus in December. You can see the move is clear internationally. And this is what active asset managers in South Africa don't want you to know. That this is the trend internationally because of performance and because of fees. It's simple. 2 factors, performance and fees. And this is why they will do whatever it takes to stop the legislation, which I think would have been in the best interest of South Africa, and why we will fight to make sure that that legislation is not swept up under the table. It might not come out in this current form. There might be adjustments, but we need to make sure that we keep it alive, and we need to make sure that we do that for every South African investor, not just because, obviously Sygnia has vested interest, but that's not the thing. I have vested interests as a saver. I have a large retirement annuity stuck in South African assets, which I don't want to have stuck in South African assets. I want the freedom to do with my money as I choose, like, most investors globally have. I don't know why old apartheid regime laws, which were introduced in terms of, exchange controls, are still impacting on me today. So we will fight. And now let me hand over to Iva to take you through some more innovation as far as Sygnia is concerned in this field of passive investing.
Thank you very much, Magda. So Sygnia is the largest provider of international ETFs in South Africa. And this morning, I want to spend a little bit of time taking you through our product offering, the kind of products that we do have on offer in terms of ETFs, as well as to let you know about 3 new, very exciting funds that we are launching in February 2021. So if we just look at our current offering, we have 2 ETFs that track local indices, but the focus of today's session is on our international offering. So if you look at our international offering, currently we have 8 different ETFs. So 6 of them are offshore regional equity funds. So if you look on the left-hand side on that block, you'll see that we have an ETF that tracks the MSCI World Index. This ETF will give you exposure to companies in developed markets. So these will be companies in the US, in the Eurozone, so you can get low-cost exposure by using an ETF if you want to track that index. Then we have an ETF tracking the Euro Stoxx 50. So these are the 50 largest blue-chip companies listed on exchanges in the Eurozone. Then we have the MSCI Japan, and this ETF will give you exposure to Japan's market, to the Japanese market. The MSCI US will give you exposure to the US market, and the FTSE 100 is an index that tracks the performance of the 100 biggest blue chip stocks listed on the London Stock Exchange. The other 3 are the ETFs that I'll spend a little bit of time this morning taking you through, because they are interesting, they have done well, and then I'll end off with a very few slides just giving you some insights into the 3 new ETFs that we're launching in February 2021. So from a performance perspective, of course, 2020 has been a very volatile year. We saw the worst of it in February and in March when global markets really sold off. There was a lot of panic about COVID-19, about lockdowns. And then once government started providing support in terms of monetary and fiscal policies, we saw markets tick up again. And in fact, there was periods where we saw, especially tech stocks, global markets sitting at all-time highs until September came. And in September, there was a big resurge in infections outside of South Africa, especially in the Northern Hemisphere. And that sent markets into a little bit of a turmoil. In October, likewise, with the resurgence in infections in the developed world, as well as the run-up to the US elections, it was a very volatile time in the market. So if you look at this October column, you'll see that markets, both locally and globally, for this period didn't perform well, but always focusing on the longer term. If we look at the 1-year numbers, we can see that the true star performer has been the Fourth Industrial Revolution Fund, and we'll go into some details why. And the other index, or the other ETF that I'll spend some time talking about, will be the S&P 500, just because it's so popular. Everybody knows about the S&P 500 as an index, and then I'll also chat to you a little bit about global property. So as much as the returns over the shorter term, this is not unique to, of course, our product range. It's been a difficult time in the market. The good news is that November has been a really good month, and we'll see performance hopefully continue on this upward trajectory. This is on the back of the US election and, of course, the positive news that we've heard about vaccines. So if we get straight into the best performer, which has been the Fourth Industrial Revolution Fund. Well, what is the Fourth Industrial Revolution Fund? It's a global equity fund, and this is available as both a unit trust and an ETF. And the index that we track is the S&P Kensho New Economies Indices. So the kind of stocks that you can expect to have exposure to should you invest in this ETF or the unit trust are companies that are all focused on new technologies. These companies are innovating. They are focused on technologies such as 3D printing, artificial intelligence, robotics, virtual reality. And these are really the companies that are shaping our future economies. And what's quite interesting and important to understand from an index perspective is traditionally, or your more typical indices are market cap weighted indices. Now, what that means is that the largest, most valuable stocks in the index will hold the largest weights. So if you think of our local markets, just as an example, Naspers is the largest stock because their market cap is the largest. So if you have to be tracking the top 40, for example, your largest exposure would be to Naspers. If another stock came along and became more valuable in terms of market cap, that would hold the biggest weight in the index. So the way Kensho does the weighting methodology is very unique. They use various algorithms, they use artificial intelligence, they use non-traditional data such as looking at satellite imagery, for example, at shopping centers to try and establish what the traffic has been at certain retailers, for example. So they use all of these very different technologies. They're looking at social media posts, keywords to try and see what the sentiment is towards a company. And they're using all of this data collectively. And their weighting methodology is really not based on size, but it's based on the impact that these stocks will make on our future, how they are propelling this fourth industrial revolution. So what you might find is that you will have exposure to much smaller stocks. Some of them, we've never heard of. They're not your Amazons, they're not your Microsofts, but these are the companies that are really shaping the future, and these are the companies that from a growth perspective really will be driving this fourth industrial revolution. So just to look back, the world is forever changing. If you think back to 2005, not that long ago, the companies that were dominating at that stage in terms of market cap, so the most valuable companies in the world, were companies that were involved in financial services or big conglomerates or companies in the oil and energy space. And just 15 years later, if we look at the most valuable companies today, they are all tech firms. The 5 most valuable companies are all technology firms. So the idea really with the Fourth Industrial Revolution Fund is to be looking ahead at what are the companies and the various technologies that will be dominating over the next decade. So hopefully if you invest in this fund and we look at a chart in 2030, we will see that a lot of these companies from the Fourth Industrial Revolution Fund will be the companies that will be the most valuable ones in the world. The Kensho New Economies indices that we track, Kensho tracks 22 separate subsector indices, and we invest in the composite. So just to give you an idea of some of these technologies, we are talking things such as the space index, the drone index, nanotechnologies, 3D printing. So each one of these 22 separate subsectors, and I'll go on to the next page so you can see some of the others, each one of these is an index on its own. So all of the companies, for example, in the clean energy index will be all involved with clean energies. They operate and own assets in the clean energy space. And the composite is made up of companies from these 22 separate subsector indices. One company, so for example, a company such as Tesla, one company can be part of more than one subsector index. So as you can see, just from the names of some of these indices, you can appreciate these really are the latest technologies, the latest innovations, and it really is thinking about our future global economy. Just to give you a taste of what the Fourth Industrial Revolution Fund looks like, it tracks just over 380 separate constituents, so it is a very well diversified fund. As I mentioned, some of the holdings are much smaller, but you wouldn't have a huge weighting towards those. As you can see from the second column on this little table, you can see the largest holding is a company called Neo Inc., and its weight in the fund is 2.7%. So it is very, very well diversified. What you'll also see in the next column next to that is just the phenomenal growth of some of these companies. They are much smaller from a growth perspective. They do have the potential to really give you phenomenal returns. And then, as I mentioned, one company can be in more than one sub-index. So if we look at Tesla, for example, we're all familiar with Tesla, autonomous vehicles. And I mean, the return has been phenomenal, just short of, 520%. So it's been an incredible performer over the last 12 months. And if it was a market cap weighted index, because Tesla's market cap is so big, it would be the largest holding. But as you can see, the different weighting methodology, the weighting of Tesla in this fund is only 1.3%. And this stock is in the autonomous vehicles, clean energy, electric vehicles, as well as the clean tech index. So it really is all about new technologies. And by investing in this fund, you can have very low cost access to all of these companies. The next one I want to look at is the S&P 500. So the S&P 500 is very popular. It's often spoken of as a general benchmark for a lot of global equity funds. And it's an index that has been around for many, many years. This index was established in the early 1900s. And with everything in life, it has been evolving, has been changing through the years. So if you look at the little chart I have included on the slide, you can see how the exposure has really changed in the S&P 500 over the years. You know, back in the day, there was a lot of companies that were focused on the rail industry, utilities, industrial, manufacturing. And then as time has gone on and as our economies have developed, if you look at the S&P 500 today, it really is dominated by technology, dominated by healthcare, and dominated by consumer companies. So this index is the S&P 500 index, ETF, and it tracks the S&P 500 index. So I wanted to cover it because it is popular and it really is a low-cost way to gain access to these big global companies. So all of these are listed in the United States, but the United States being the largest economy in the world at the moment, it is really good to have exposure to some of these companies, and the performance has been phenomenal. So if you look at the actual product, so the ETF tracks the S&P 500. These are all equities that are listed in the United States. And from a total investment charges perspective, the cost of this ETF is only 19 bps. So it really is a great way to gain exposure to the US market at a very low fee. Some of the companies that you would have exposure to would be companies such as Amazon. Now we know that Amazon has been one of the star performers, especially through this pandemic, because they are an online retailer, they focused on digital streaming. So it really has been the right environment for a lot of the tech stocks such as Amazon. And just if you look at this chart, you can see that exponential growth over the last couple of years of Amazon. And another stock that's also very well known, household name, is Microsoft. And again, from a performance perspective, you can see how well they have done over the last couple of years. And the beauty about ETFs, so this example is of course with the S&P 500, but this goes for any ETF. The beauty about ETFs is that you can purchase one instrument that trades on a JSE. You can purchase it so easily, either via a platform, or if you have a stockbroking account, you can simply type the code, search for the name, and just purchase it off your stockbroking account. It's very liquid. As Magda said, these instruments trade on a JSE. You can buy it at 11 o'clock today, sell it at 1 o'clock on a Friday. The liquidity and the ease of access is really phenomenal. And for me, the real beauty about ETFs is that you're purchasing that one instrument that packages a lot of stocks. So using the S&P 500 as an example, you will have exposure to 500 stocks by purchasing just that one instrument. And just looking at some of the prices in US dollars of a single share, if you look at Amazon, a single share costs over $3,000. So if you wanted to yourself gain exposure to some of these stocks, it would cost you a lot of money to gain exposure, even just to the top 10 holdings. And with an ETF, you can invest 500 Rand, you can invest 1,000 Rand, and you will have exposure to the performance of all 500 of them altogether. So it really is a good low-cost way to gain exposure to these phenomenal global companies. And over time, the S&P 500 through time has done really, really well from a performance perspective. The next ETF that I want to spend a little bit of time on is global property. Now, when you think of property, we often think of our residential properties. We might think of office spaces that we see. We think of shopping centers and retailers, but global property, or property in general, is a lot more than that. So property has various subsectors. Some property companies are what we call diversified real estate. That would be if a property company is involved in more than one major activity. So it might be a property company that's focused on healthcare, but in addition to that, they're also focused on storage facilities, for example. Then you have your hotels and leisure. Now, we can already anticipate that this is the one sector that hasn't done too well through this pandemic. But the point I want to make today is that different subsectors have been affected differently by COVID-19, and I will show you some of the performances of the various subsectors so you can see that there are pockets of opportunities even in the property sector through this very difficult time. Then you have your industrials that's focusing on warehousing facilities, distribution, manufacturing bases, office space, healthcare, retail, storage is a big one that's done really, really well. You have specialized real estate as well as residential. So there are various subsectors. From a performance perspective, if you look at it over the very long term, this performance goes back right up to 1993 up until 2020, you can see that the clear star performer over here in terms of subsectors has been the self-storage space, followed by residential and healthcare. And some of the other sectors have done a little bit worse, but these are really the performers. Whereas looking at it over the shorter term, of course, this is year-to-date performance. So you can appreciate we find ourselves in a very difficult situation. Borders have been closed. People are not allowed to travel for leisure or for business. So it's no surprise that unfortunately it's the leisure, the hotels and the resorts that have been the hardest hit subsector from a property perspective. On the other hand, there has been some good performers, and that's your data centers. We're all doing online shopping. We're utilizing technology a lot more. So those have been the winners of the subsectors. Infrastructure, industrial, and self-storage have done very, very well. So when it comes to a product, no, not every property index is the same. So the specific property index that we are tracking with this ETF is the S&P Global Property 40 Index. So it's focusing on the 40 largest developed market property companies. Each one of these 40 companies will have a maximum weight of 10% in this index. And from a fee perspective, the total investment charges are 0.26. So this is a very cheap, very low cost way to access the global property market. So just to, as I said, the different indices are different in terms of what you can expect in terms of performance, what you can expect in terms of exposure. So looking at that first column, this is the index that our ETF is tracking, the S&P Global Property Index. The constituents are just 40, so we will always be tracking the 40 stocks that are in that index. As one falls out, another one may be added in, and we will track exactly what's in the index. Whereas looking at the S&P Developed Property Index, for example, that's made up of 533 constituents. In terms of whether we're tracking developed or emerging markets, we are tracking developed markets only. And if you look at just the breakdown of some of the broad sectors, you can see that relative to the other two indices, the index that we are tracking with this ETF does have a lower exposure to the retail REITs, lower exposure to offices, and zero exposure to hotels and resorts, which of course is positive for this environment. And even looking ahead, we do believe that it will take quite a bit of time before that sector is profitable again and back to the levels that they were in 2019. And the reasons for that is, of course, the pandemic, the restrictions of travel. But even though we have positive news on vaccines, we do know that in practicality, just because the vaccines have been, proven to be effective, it doesn't mean that we, all going to get a shot tomorrow. It will take quite a bit of time to distribute it to the rest of the world and for the pandemic to really be under control. And in addition to that, of course, as Magda mentioned, the consumer is in trouble now. People have lost their jobs. Some people may have lost one income in a household. So just from a consumer perspective, it also will take a little bit of time until people are able to travel, splurge on lavish holidays, and until that space of the market is back at really profitable levels. So the Global Property Index, the Global Property 40 Index that we're tracking is very well diversified. And over here, you can see the various exposures that you would have should you track this index. And you can see that the bulk of the exposure is in specialized REITs, in industrial, residential, and then, of course, the diversified real estate. In terms of office and retail, you can see the exposures are much, much smaller. And with everything, there's always pockets of opportunities. There's always companies that are able to do well. So as much as the property sector, both locally and globally, has been really badly hit this year, there have been some really profitable companies. So if you look at the 5 largest holdings in this ETF, I've listed the companies over here. You can see some of their weightings. The largest weight is 9.9%. But from a performance perspective, the top performer has been this Digital Reality Trust Inc., and they've delivered 20.5% year to date this year. And this year has really been tough for any of these property companies. So all of these top 5 holdings have done really, really well. And the actual index and the specific stocks that we're tracking, we believe is well placed for the current environment and the environment of the near future. And in summary, if you think about property, yes, these are very uncertain times. Especially the pandemic has really hit the sector hard, but we do believe that property is an important inflation hedge. And also, if you think about broadly about property at its core, real estate is there to provide shelter, to facilitate commerce. So as our needs change, and there will be a lot of structural change that take place, because of this pandemic, we are all getting used to, working from home, maybe doing online shopping. So yes, there are changes taking place, but property in itself, it won't disappear. And we do believe that it is still a growth asset class, and it's important to have exposure to this asset class. And now I want to end off with telling you a little bit about the 3 new ETFs that we are launching in February 2021. So you saw that our current offering is 8 ETFs that track global indices. So from February next year, we will have an additional 3. And all of these also give you exposure to indices outside of South Africa. So the first one is our ESG ETF. So the index that this ETF will track will be the S&P Global 1200 ESG Index. So ESG stands for, the E is for environmental, S is for social, and G is for governance. And these are important characteristics to focus on before investing in an asset. Now, ESG investing has become, ESG has become quite a buzzword, and ESG investing in itself has become increasingly more important, especially for institutional investors. In fact, retirement funds now have to, in their IPS, write exactly what they're doing from an ESG perspective. So what measures they're taking in terms of research, what resources they might be making use of in order to make sure that the assets that they invest in meet these environmental, social, and governance characteristics. So it's all about investing in companies that are doing the right thing when it comes to climate change, the right thing in terms of treating their employees fairly, paying fair remuneration, providing good health and safety measures in the workplace, and then from a governance perspective to make sure that the stock that you invest in ticks all the right boxes. So the kind of stocks that are excluded from this index would be, for example, stocks that have operations that are very bad for the environment. So it could be a lot of the electricity that comes from coal, tobacco kind of products. So those are immediately excluded from the index. And the stocks that land up in the index all tick the boxes in terms of these ESG characteristics. And I mentioned that it's become very important for institutional investors to take care and make sure that they're investing in stocks that are ticking all the boxes in terms of ESG. But there's a lot of studies that are showing that individuals are becoming increasingly more aware of the impact that their investments might be having on the environment, for example. And especially the younger population, millennials, are really have a focus on having their investments aligning with their personal values. And from a performance perspective, it's also, there's many studies that also show that the companies that actually are doing the right thing and do tick the boxes do tend to outperform the companies that, for example, aren't ticking the boxes in terms of ESG. So ESG, for us, it is very important. We are very focused on being responsible investors and having a true impact, in addition to being able to provide our investors with great returns. So just to give you some flavor of what you could expect in terms of top 10 holdings, you'll see a lot of these stocks are very well known to you. It's the likes of Apple, the likes of Microsoft, the likes of Amazon. And again, from a performance perspective, you can see that they have done phenomenally well. The other ETF that we are launching is one that we are very excited about, and it's the Emerging Markets ETF. So the specific index that we will be tracking will be the MSCI Emerging Markets 50 Index. So again, we'll be focusing on the 50 largest, most liquid emerging market stocks. On a look-through basis, if you have to look at these 50 holdings and you see which regions they come from, about 50% of the exposure will be exposure to China, and about 80% will be other Asian economies. Now, why that is important is these are the economies that have a very fast emerging middle class. And of course, as the middle class emerges, they start to spend, and that's when economies and GDPs tend to do very well. So looking at some independent data sourced from the World Bank and IMF, they predict, if you look at the little graphic I have on the left-hand side, they predict that by 2024, which is only a few years away from today, 4 of the 5 largest economies in the world will be Asian economies. So it is definitely an area of the market, a region of the world that cannot be ignored from a growth perspective. And as I mentioned, it really comes down to that growth of the middle class. And if you look at the little graphic I have on the right-hand side, you will see that now in 2020, 54% of the middle class, the world's middle class population, is coming from the Asia-Pacific region. And over the next decade, 65% of the world's middle class will come from that region. So again, definitely a region that cannot be ignored from a growth perspective. There's also been some phenomenal technological innovation that has come from those regions. If you think of companies such as Alibaba, such as Tencent, even our very own Naspers, these are all phenomenal emerging market tech stocks that have done really, really well. So in terms of top 10 holdings, this is the exposure that you can expect. These are the companies making up the top 10. So it is very technology focused at the moment. And again, looking at the last column, you can see how phenomenal the performance has been over the last year. And just comparing this specific index, so the Emerging Markets 50 Index that's focused on just the 50 largest stocks in the emerging market space relative to the broader MSCI Emerging Markets Index, you can see how especially over the last 5 years, the EM50 index has outperformed the broader index that has more constituents. And then the last one that we are launching is another very, very exciting ETF, and this one is focused on healthcare. So here we will track the performance of 150 global developed market stocks. Now, healthcare in itself is top of mind at the moment because we find ourselves in a pandemic. But we do believe that this is not just a focus right now, but it will be an increased focus in the future. A lot of governments have been caught off guard with the pandemic. They have realized that they, might not have enough hospital beds. They might not have enough, workers to be able to, test enough, not enough nurses, not enough spend has been, provided just for healthcare. So thanks to, this pandemic, the fact that we have aging populations, and the fact that a lot of experts have warned that it might not take another 100 years before we find ourselves in a pandemic again. The next one might come a lot sooner. Governments will have a much bigger focus on healthcare. This is just having a look at some of the spend from governments, and this is back in 2018. And we can see that the United States, the biggest economy in the world, spends 17% of their GDP on healthcare. And you can see the big percentages from the rest of the globe. Now, looking forward, as I mentioned, we can expect the spend to just increase and get much larger as a percentage of GDP. There's also a lot of innovation taking place in the healthcare space. There's now, you can print organs, and you can print an ear or human tissue with 3D printing. Virtual reality is being used to simulate training environments. Artificial intelligence is being used to assist with diagnosing a patient. So there's so much innovation. The future of healthcare will look totally different than the healthcare that we know today. And from a performance perspective, it's also evident this massive focus on healthcare, these aging populations really have contributed to some of these healthcare companies becoming very, very profitable. And you can see over the last decade, if you just compare the MSCI World Healthcare Index versus the broader developed market index that includes other industries, you can see that healthcare is clearly outperforming the broader global markets. So we do believe that it's important to have exposure to healthcare in your portfolio. It's also a sector with very limited availability in South Africa. There's very few stocks listed in the JSE with a healthcare focus. The government focus has never been larger. There's so much research and development taking place in the healthcare. And then the performance has been phenomenal. And the performance is likely to continue to be really phenomenal with this increased focus on treatments, with COVID-19 that will be here for quite a long time. And in terms of top 10 holdings, some of these are very well-known companies, the likes of Johnson & Johnson's, Roche, Pfizer, and as I mentioned, this ETF will track 150 developed market stocks. And I had a look at an article from Bloomberg that was showing the various companies and how far they are in terms of their vaccine developments. And if you look at all of those companies, we have exposure to 9 of them in this Healthcare 150 ETF. And just to end off with passive management and ETFs, which of course is passive, as Magda said, the proof is in the pudding when it comes to performance, when it comes to fees. Those are the 2 most important things. Of course, the performance that you experience is the net to fee performance. So it's important to have a low-cost vehicle to be able to access really interesting strategies outside of South Africa to diversify your portfolio. And it's very clear to see that the trend in South Africa has not been different to the trends overseas. There's more and more investors waking up to the fact that passive investing in ETFs really are the future. And you can see what the growth of our AUM in passive solutions has been over the last years. So we truly do believe that ETFs are the future and that we are very well positioned with a great offering of some more traditional indices and some more exciting indices that we do track that will give you exposure to some very good companies that are set to do very well in the future. So I'll take some questions now. The first question is talking about the fees. The question is why, when you invest about 500 Rand a month in an ETF on the Sygnia platform, nearly 100 Rand gets taken off in fees. So 100 Rand doesn't sound right to me. I would welcome a direct email and we can maybe have a look at your specific experience, but the fees are different for different products. So some of the ETFs are more expensive than some of the others. So it all depends on which specific ETF we are talking about. And the fees, you can look at the total investment charges, and all of the fees of all of our full range of portfolios is available on our website. But I do welcome a direct email where we can look at your specific personal experience. There's a question that's asking, can you please let me know how do ordinary members and individuals comment or contribute to the public participation that is currently underway? There was a statement issued saying that stakeholders and the public are invited to comment and submit comments. And the email address is sabportfolio@resbank.co.za. And these public comments have to be submitted by the 15th of December 2020. And as Magda said, we are providing a very comprehensive input on that circular from our perspective. There's some comments saying Magda fight on and expose the big asset managers. she is fighting, and she's fighting very hard for exactly what is right and in the best interest of investors. There's quite a few questions here for Magda, so I will allow her to also have I'll log off quickly, and I will let her then take some of the other questions. There is a question here that is asking about the Fourth Industrial Revolution Fund, and it says, why is there both a Fourth Industrial Revolution unit trust and an ETF? Well, firstly, the ETF tracks the index exactly, whereas the unit trust does at times have exposure to some different instruments. So as much as the bulk of it is tracking that S&P Kensho New Economies indices, you may find that at times there might be small exposure to the Oxford Sciences Innovation Fund. So that's number one. And number two is we do appreciate that different investment vehicles may be more appropriate depending on what you're trying to achieve. As Magda explained at the beginning, ETF is essentially a unit trust that's trading on the JSE. So if you want that quick liquidity and that pricing that is different throughout the day and a very easy, accessible instrument, the ETF is that, and then the unit trust is of course more traditional unit trust, but as I said, you might find that there's a little bit of a different exposure in the ETF. So with that, I want to thank you for coming and joining our webinar today, and I will now hand over to Magda to answer some of your questions.
Hi everyone. For whatever reason, I'm only seeing few questions on the screen. So if you want, probably something to do with technology. So let me answer the questions I can see. I can only see 7 questions. So if you've got more specific questions for me, please retype them. I missed hearing when the new ETFs will be available on the platform. The ETFs will be available around February because we're going through the approval process right now. There is a question which says, does the demand for specific ETFs influence the TER? No, they don't. However, I mean, not to a significant extent, only to an extent that you have to create more units and buy shares if there's a huge volume of demand. But then that volume of demand is then handled not by the ETF you're seeing, it's handled by the market maker to make sure that the costs are not influenced and the TER is not influenced. And also, with huge demand, particularly by large investors, we can always negotiate fees down. Can tax-free savings account be used for global ETFs funds? Absolutely. So you can use tax-free savings accounts for any ETF. And in particular, it's quite a good vehicle to use for tax-free savings accounts because tax-free savings accounts don't allow for performance fees. So, ETFs by their very nature cannot charge performance fees. In terms of the health ETF differing from Health Innovation Fund, it's exactly the same tracking. Before this ExCon regulation circular came out and the knowledge of everyone, everyone's knowledge of exchange traded funds suddenly peaked, there were different target markets for ETFs. So more professional investors, funds of funds used ETFs, and different target markets for traditional investor who used unit trusts. So we decided to launch, just like with the Fourth Industrial Revolution Fund, we decided to launch, the parallel products to address different target markets. If obviously the ExCon circular stands, then I think ETFs will just become a mainstream product for a lot of retail investors and institutional investors. And hence, really it's horses for courses. There's no difference between the two. There is a question about total investment costs plus list fees plus stockbroker fees. If again, it depends on which particular ETF one is looking at. So for instance, in the instance of S&P 500, the TIC is, I think, in the region of 0.19%. taking trading costs into account. The list fee is 20 basis points, so half of the list fee of any other list, and any other list providing access to unit trusts or ETFs. And then stockbroking fees, I think we have reduced to 10 basis points again. So it's just to cover, remember that stockbroker fees are not just pure revenue to the stockbroker, they also have to cover JSE fees, which are around 5 to 6 basis points. That's why stockbrokers are slowly going out of business. So, you know, when you add it all up, you know, traditional unit trusts, you would pay a TIC, you would pay the list fee, you might not pay the stockbroker fee. You know, within the ETF, the stockbroking fees are usually hugely discounted. Bitcoin ETF, working on it. Let's see whether the JSE takes a different approach. The new JSE and the brand new management takes a different approach to a Bitcoin ETF than the previous JSE did, because with the previous JSE regime, we were literally 2 days from the launch of the ETF when they pulled the plug. So we were launching on Wednesday and listing the Bitcoin ETF on Wednesday, and on Monday I got summoned to Johannesburg and I think screamed at for about 45 minutes. But none of those people are around any longer. JSE has a brand new team, brand new management team. So we are engaging, or in the process of engaging. I mean, I still have concerns that this is, so even if we do launch a Bitcoin ETF, it will come with disclaimers from here to Timbuktu. The SAS Reserve Bank email address, I will publish it on my Twitter account over and over again. It is in the official communication, but we will make sure that we keep reposting that email address so that everyone can submit comment. Are the fees available for the new ETFs, which will be made available in February? Yes, we will post marketing sheets for these funds as soon as we can, together with the relevant fees. But, you know, take your guide for certainly the Health Innovation Fund will be very similar to the Fourth Industrial Revolution Fund. So none of these products will be higher than what we are currently charging for Fourth Industrial Revolution. And I think that is 0.5% per annum. You can invest in through your Sygnia array. Can you invest in ETFs? Yes, you can. You can invest in ETFs, and you can invest in ETFs through our platform under any wrapper of your choice. I love this question. What will be your ideal fund selection in Sygnia for an array if sub decision remains as is? Okay, so I'm going to give you Magda answer, not investment team answer to that one. You know, if they decide to do what they're doing, which hopefully reason prevails, but if not, then I think, you know, the genie is out of the bottle a little bit. People's awareness of the need to be diversified offshore more is at sky high, at kind of very high levels, particularly within arrays. So what we will do, I mean, many people don't realize that some of the largest, apart from NASPers, around 48% of the JSE currently consists of shares which have absolutely no operations in South Africa whatsoever. So they actually might as well be inward listed foreign shares. Naspers is the obvious example with Tencent, but BAT, Richmond are exactly the same. No operations in South Africa whatsoever. It's a, you know, listing wrapper on the JSE. So I have a dream of setting up, I mean, I'm not going to say it's possibly the most sensible, but I want to design a portfolio for those with an appetite and belief that they want to diversify away from South Africa, and probably not in line with Sygnia's best house view, because that's reflected in our signature and skeleton range, but a portfolio with a maximum covert and overt offshore exposure. So basically that's where you take the domestic equity component and structure it premised on all those companies which don't have exposure to South Africa. And between that 35% and, including some possibly offshore rates, property funds, and those domestic shares, you can actually achieve a Regulation 28 compliant portfolio, which is 75% offshore exposed, as is. So we will look at structuring that kind of a portfolio for investors, for those that believe they want to just externalize their money. And, it's not ideal. And I will point that out in Sygnia's submission. I will point out that portfolio in Sygnia's submission to the Reserve Bank, and how unsatisfactory, achievable, but unsatisfactory it is to structure a portfolio which is 75% offshore exposure. And hopefully those kind of arguments start resonating with the Reserve Bank. What's your view on the drop in gold? I'm crying because I took quite a bit, big position in gold, worked for a while, and then I was very slow moving out. People are not moving out. People are into cash. People are moving out of gold into equities, because with the with the COVID crisis continuing, and with money being printed at record pace, I mean, you've never seen so much money printing, in your life, not even after the global financial crisis. There's so much liquidity, so much ability to borrow at effectively negative interest rates, that foreign investors, and by that I mean, large hedge funds, large asset managers, large investment banks, are borrowing money at zero and throwing that money at equity markets, which is what you have seen. You have seen, acceleration in the move of equity markets, complete decoupling from the fundamentals of what's happening on the ground, chased by enormous amount of money. And that is why money is moving out of the gold. Has traditionally been perceived as a conservative investment in the time of uncertainty. And what you're seeing is people now removing their gold positions, which they put on in March, April, May, and moving back into international equities. If one purchases Sygnia 500 index trackers on easy equities, there's no LISP fee. I think there's no LISP fee, but there are stockbroking charges. So if you go on Easy Equities website, just search for a document. I don't think it's on the front page. It's a couple of pages in, on fees that they charge. So Easy Equities charges stockbroking charges. And just look at those charges, and then you can compare it to what Sygnia charges on its platform, which is, I think, 20 basis points, to determine which option is cheaper. We really don't mind. If investing in tax-free savings, would you recommend a unit trust, Fourth Industrial Revolution unit trust, or ETF? You know what? Indifferent. I think the Fourth Industrial ETF is cheaper than the unit trust. So frankly, I probably would opt for the ETF. Can we sign your opposition? We're finding a way to get more people to, in some collaborative manner, sign a submission to SARB. So we're working on it, and we'll communicate accordingly. Why do your annual tiered admin fee apply individual to RA accounts and not to the total of my portfolio invested across multiple RA accounts? We don't charge admin fees on RAs. We only charge the underlying unit trust fees. So there isn't a tiered structure on our RAs. All our savings products are offered free of platform fees, free of product fees. And all you're seeing is different fees coming through as a consequence of whatever unit trusts you are using, or ETFs, and the management fees related to those products. There's absolutely no RA fee on Sygnia platform, and there's no platform fee on Sygnia platform if investing in Sygnia products. There was an interesting one. Sorry, pensioners are obliged to use unit trusts to receive a pension from an annuity. you don't need to use unit trusts, you can use ETFs. Within your living annuity wrapper, you are free to invest in anything you wish to, and you don't have to follow Regulation 28 limits. So you can invest 100%. It would be foolish because your liabilities are in South Africa and you need high income, which you get from South African bonds, but you are not bound by the limit, 30% offshore limit, and you can invest in whatever you want. You can invest in unit trusts and you can invest in ETFs. Our MSCI World Index is more expensive than, our MSCI World Index has a tiered fee structure. So we are obliged to publish the highest tier fee, I think, on the fund fact sheet, but our fees go down as low as 40 basis points on MSCI World. And also the other thing you need to compare, the other guys all have feeder funds. So they don't actually manage the funds themselves in South Africa. They charge a feeder fund fee, and then they invest typically with BlackRock or another provider overseas who does the actual tracking. And that provider charges a fee as well. But what I would urge you to do, so tiered fee structure on MSCI World going as low as 40, and we're always negotiable. And then, the other thing you can take into account is our bid offer spreads, because with Jane Street, we're maintaining the tightest bid offer spreads, literally 0.25% away from NAV. Many of the other providers of ETFs with feeder funds either do this market making function themselves, or use domestic players, and you'll find that you're paying spreads of sometimes 1% when investing in these ETFs. So compare costs. Okay, I've managed to switch my RA fund to offshore. So now my RA is no longer compliant. Nothing happens now, you can keep it the way it is. Your RA can be non-compliant for 1 year, that's 100% correct. And let's see what happens next, because I would also argue that there was a law in place for 3 weeks, but it was in place, and that now it has been amended to something else. You cannot amend legislation retrospectively to affect retrospective actions of individuals. And hence, sit tight. Sygnia RA, when will I be able to diversify, start investing in ETFs? You can do it right now on our platforms. For ETFs, we do have a small admin fee. And there are reasons for that. We need to cover certain costs associated with administration of ETFs, which are not present in unit trusts. So we've looked at it, inside out, upside down, whether we can strip out those platform fees. But actually, those platform fees don't go to any profits that Sygnia makes. They actually cover costs inherent in a list platform investing in an ETF. So we do apply a small admin fee on ETFs. But that's why, for instance, we have higher fees on the Fourth Industrial Revolution unit trust and lower fees on the ETF, because the lower fees plus the platform fee get you roughly to the same level as the unit trust. So we try not to do this fee arbitrage. Let me just see what else. You guys doing a great, well, thank you for all the questions and all the comments which are congratulating us and thanking us. We thank you for your support, most importantly. When will the Alchemy platform be updated? The $1 million question. It was supposed to be updated in June 2019 by the largest international provider of platforms, which has just recently announced that they acquired Silica, which also provides administration to many unit trust companies in South Africa, as well as providing the 91 list. So now I know what they've been busy with instead of implementing the platform technology at Sygnia. We're working on it. We are hoping next year. I mean, I wish I could, I don't even want to give you the timelines, because we get updated timelines once a week. I scream once a week. And then next week we get another updated timeline. Which ETF would you say is the best for someone investing for the first time? and planning to invest a lump sum of 20,000. You know, I mean, my split would be, and I'm assuming you're young, and I'm assuming you are not someone in your 50s. So if I was 25, I would say you split it between fourth industrial revolution 1/3 and 2/3 S&P 500 index fund and forget about it. And then you literally forget about that money. And do it through a tax-free savings account, by the way. So make sure that first time, 20,000 Rand tax-free savings account wrapper on top. I'm process of moving RA to Sygnia. Do you suggest waiting till sub ruling is final before selecting? Would like more international exposure? Look, you don't have to, you know, it depends on why you're moving your RA to Sygnia. Hopefully it's the performance of our funds irrespective of the sub ruling and the fact that our fees are so low relative to competitors. So our absolutely top performing Sygnia skeleton funds, which are Regulation 28 compliant funds, outperform most active asset managers in South Africa, and they charge a fee with VAT of 0.4% per annum, as opposed to 1.5% that you will be paying to others. So hopefully those are motivations enough to continue moving to Sygnia. And also, you know, any relaxation in foreign exchange controls, any gap that they give us, we will take immediately, as we have this time, and pass it on to you as investors. So as opposed to others who will delay, drag. So I'll give you an example. If this ex-con circular was to stand, it was to stand and wasn't suspended, then most LISPs wouldn't and don't, to date, offer access to ETFs. So if your RA is with 91, for instance, or Ellen Gray, even though the ex-con circular was in motion and alive, you couldn't move into ETFs because those LISPs, the only LISPs that offer access to ETFs are Sygnia, Satrix, and Easy Equities. And I think that even if the ex-con circular is reinstated, maybe in slightly varied form, those LISPs, other LISPs will do the utmost, because they're owned by large asset managers, to keep ETFs off their platforms for as long as they possibly can. That's another protectionist measure they can take. How would you split into ETFs? Oh my goodness. Okay, there's a 68-year-old with $1 million to invest. Please, then please email us. Please email us, call center, and in that case, you need proper advice. It's not going to be advice given over a webinar. Please email our retail division, and it will find its way either to me or one of our heads of investments, and we will look at your entire circumstances. This is a wrong question to ask in a webinar. Do you expect tech companies that recently took off to come back down in the near future? I think that what has happened with COVID-19 is the world has changed, and we have moved to virtualization of engagements. I think certain habits will never change. I mean, I have to be perfectly honest. I buy everything online that I can buy online. Before, it was popping off to the shops. Now, not even for my designer clothes do I bother going to a shop. I frankly know my size, go on the website, click a button, and the outfit gets delivered within a couple of days. So given that certain trends, and I'm not talking about all tech companies, which might have been swept up in this bubble, but tech companies which provide access to, online shopping, any streaming, entertainment streaming services, Netflixes of this world, etc., gaming and gambling companies in the tech space, anything that facilitates virtual engagements, Zooms of this world, and any companies that on an auxiliary basis benefit from virtualization. So this is courier companies, delivery services, food delivery services. I don't think the stocks are going to materially come down. you know, it's not to say that there isn't going to be a correction at some stage, because obviously, as you know, one thing about investment markets, what goes up too rapidly must come down. But I think that the new levels of revaluation are here to stay. So up, some down, plateau, and then slowly up again. That would be the typical pattern. Is it a good idea to buy 50% MSCI World and 50% of MSCI World ESG? Choose one. There isn't a material difference. I wish I could tell you that there's a material difference between ESG compliant products and non-ESG compliant products, but there really is negligible difference. And I think we are recording this session, and we will post on a Twitter feed, Sygnia Twitter feed, where it will be available. And I think, that brings me to the end of the session. Thank you to everyone for listening and hanging on and asking questions and participating. And please be there, be on social media, voice your dissatisfaction with what has happened, make your voices heard with regulators, not in a ranting manner, but in a manner which motivates for better returns on your savings. So, I'm not in it to fight the regulators. I'm in it to persuade them that better growth in savings are better for investors, are better for South African economy, are better for the consumer, will generate more taxes. That's what we want. That's the argument we want to get across to regulators in South Africa. It's not, it's not the rants about ANC corruption and lost years of Zuma administration, Those things have happened. We can't undo them. I don't think that these are motivators for regulators to change ex-con regulation. So it must be win-win arguments and motivations where allowing foreign exchange control relaxation is in the best interests of the saver and South Africa. And that's the message we need to keep reinforcing to regulators. And not in, aggressive manner. I mean, I will be aggressive towards ASISA. I think it's a particularly insidious lobbying group. And I just received a nasty letter from ASISA, as you can imagine, about, I again choose to attack the industry I have chosen to be part of. Well, yes, I have chosen to be in the financial service provision. I have not chosen to be part of a cabal which acts against the interests of investors. I have not chosen to offer passive investing at low cost to rip off the consumer. Somehow that letter just didn't resonate with me in terms of why I should stop attacking active asset management industry and the lobbying groups that they fund, such as ASISA. But anyway, thank you again. Have a good afternoon. I know it's Monday and a long week awaits you. So I appreciate the fact that everyone logged in and hope to speak to you soon. Please watch our Twitter feed for further updates on our submissions. Bye, everyone.